And then also thank you, David, for coming. He has joined the good guys. He has left the IRS and now he's fighting for us. So thank you for being here. We're excited to hear your class.
Thank you. Yeah, thank you for having me. What a fun topic, taxes, right? I mean, didn't you just want to get up this morning and go to a tax class? Well, taxes it's so much more about just zeros and ones. It's about paying less and buying more stuff that you love, buying more stuff that you enjoy. It's the emotions. Taxes is emotional, just like real estate. Real estate is very emotional. So how can we take the emotion out of it and just get back to maybe the logic and maybe what is the best thing for our pocketbook, our cash flow now, retirement, and upon death? And really thinking about overall big picture, and especially with the new big beautiful bill, there's a lot in the media, a lot in the news. And I'll read, I'll hear, I'll listen, and I'm like, this doesn't make sense because somebody has a point of view and they're trying to politicize it. We all have point of views. I have a point of view, but it's like I have an opinion, but I don't have a yard sign. I want to talk about tax savings. I want to talk about all the fun stuff that you can buy and enjoy with the savings, and it's about cash flow and it's about leveraging. And the wealthy individuals have realized that if I can leverage my tax and not pay the tax now, but buy other things, buy other investments, buy other properties, and reduce my taxes legally, ethically, morally, decrease that audit. And I'm the former IRS auditor, and I spent 6 years auditing. So I understand where the IRS has been, where they're at now, and where they're going, especially with 25 to 40% cuts in IRS staff. And the IRS audits bring in $87 billion. And with people not actually auditing, Congress still wants their money. So how is that going to be backfilled? How is that going to be replaced? AI. AI is going to be auditing. So we're seeing a lot of new trends, a lot of new things that we haven't seen before. But really, it's the same thing. There's nothing new under the sun, right? It's what is the algorithms looking for? And it's well noted and well documented that the IRS is biased. They have bias. And I've taught a lot of classes on bias, and there's universities and there's Treasury Inspector exam, TIGDA, that has looked at these bias, and it's well documented because people have bias. And bias are things that are under the surface that we don't think about, and we just have. It's not like a cognitive, like I know this. It's just it runs under the surface. It's like a operating system. Anyway, so we have bias, and so we all have bias about taxes. Some people are like excited about taxes, some people are like afraid of taxes, right? And that's a bias, and we might have had those things since we were kids. But I want to try to break through that and say, look, taxes are interesting, they're fun, they're exciting because we can leverage it. We can now look at the incentives that the government is giving us and use those incentives and start stacking those incentives to pay less tax and to be ahead, because there's things that we're going to be talking about are phasing out, like energy credits and stuff, and things that are going to be phasing in. As I go to the next thing, we have disclaimers here. We have my agenda. So we're going to be talking about critical deadlines, the expiring clean energy, key effective dates, timelines. We're going to be talking about exit planning, because everything is about exit. We think about Dr. Stephen Covey, as he says, we start with the end in mind, right? And we work backwards. We think about, oh, we'll get to it later. Well, what happens later, and I've got a lot of people in their 70s, and they're like, oh, I'm going to be in a lower tax bracket all their life. And now they're in their 70s, they're like, I'm paying a lot of tax. I'm paying more tax than I thought. Everybody said that I would pay less tax. And when people are in retirement, they have IRMA cliff. They have this IRMA, which is the Medicare, and the IRMA is an acronym, but it's an adjustment for inflation. There's a Social Security torpedo. We got to think about those things to tax plan now, retirement, and upon death, because taxes are our biggest expense that we have over our lifetime. So we want to reduce those legally, ethically, morally, like I said. Business strategies, and then income deductions. There's a lot of stuff in the news about tips and overtime and senior deductions and more. and we'll talk about that. There's a lot here, a lot more than that are in the slides than I can probably cover today in class. But that's why I have the slides, and I'll have the recording and for you guys so that you can tap into it and research it and talk about it later. So I want to give some practical tips and ideas. As we get into this, I want to look at the expiring credits. So with the EV electric vehicles, the $7,500 for new and the used for $4,000 is going away September 30th. So if you're going to plan on buying an EV, do it soon, because after that date, that credit goes away. And then over here, the energy efficient homes, those things are going away. So the current administration is moving away from renewable energies to back to fossil fuels and drilling and that type of stuff. So there's a lot more credits, but then there's also more incentives for manufacturing back on US soils, and we'll talk about that also. But anyway, so these are some of the expiring credits. The energy efficient for buildings, that's going away. So if somebody has a commercial building, to take advantage of these energy efficiency credits middle of next year. But anyway, so we see this timeline, and there's just a lot of phase outs and phase ins. This bill was like over 900 pages. It was massive. I'm trying to read tax or a bill. It's so complicated. And I've heard that it's going to take years for this thing to be unpacked, right? It's like years for different legislations. And every 2 years or so, there's a changing of the guard, right? Because in 2 years, who knows who's going to control the House and the Senate. And the big race for California right now, because California is the third or fourth largest economy in the world. So whoever gets governor, it's very political. California detaches from the federal. They're like, I don't care what the federal does from a tax standpoint. We're going to do our own thing. The state of Oregon primarily does and follows federal, but we'll see with all these changes what they're going to be doing and will they follow everything or not. But it just really depends upon the state, it depends upon the region. Like in Sonoma County, there's the city of Portland, so there's all these different taxing agencies. The federal, it makes sense, it's easier because it's across all 50 states and territories, but then each state, there's hundreds of taxing agencies. There's some taxing agencies that tax the cookies on internet, so the cookie tax and stuff. It's just crazy, right? So they're like, if you're going to market in our state, we're going to tax you on soliciting to people in our area. This is a big change, the 100% bonus depreciation. And it's really, really, really important because as of January 20th, it's a political date because when Trump was inaugurated, it's not arbitrary, it's political. He basically said, well, if you're under the Biden regime, you're under the old rules of 80 and 60% phase out. But if you have bought something as of January 20th, and so that's where these dates are really important, then you could get 100% bonus depreciation. And that makes a big difference, especially if you're buying a vehicle, rental properties, whatever, and we can break those things out and save on taxes. Okay. We take depreciation, we buy, say, a car for $80,000 or whatever, and we have to depreciate it out over 5 years. Or there's different things, like they say, hey, this table costs $4,000 or whatever it is. We're going to have to depreciate it over 7 years. So with bonus means that we get to accelerate that and take that now. And so if instead of you having to take like this desk or a car or parts of a building over a certain amount of time, and you could expense it now and save on taxes now, then you can reinvest that savings and that income that you were going to spend on taxes into other projects, into lower interest rates, whatever that you want to buy if you're going to buy income producing properties.
But before January 20th, it stays at that same rate?
It was phasing down. It phased down. It was 100% in 2022. 2023 went to 80 and then 60%. So if you bought something on January 19th, it's at the 60% bonus depreciation. Nobody knew that until July 4th, right? Until this thing got passed. So it retroactive to January. Just depends upon when they bought it and what the service state was, and if we can do something called a cost segregation example and breaking that down. Anything that lasts greater than a year, we have to depreciate. Anything lasts less than a year, you go to Costco, you buy a $500 printer. Technically, it's supposed to last greater than a year, but the paper, the toner, ink, same thing with the car. Car lasts greater than a year, the gas and oil and stuff doesn't. So you get to expense the things. With the safe harbor, there's a $2,500 safe harbor rule. You get to expense it because they consider it de minimis. I buy the $500, I gotta depreciate. IRS is $2,500 for most people. If you're a publicly traded, audited company or over a certain amount, you can take up to $5,000 per expense item. The devil's in the details, right?
That's why having a good tax guy is important.
Yes.
Because we don't know these things.
That's where education and a lot of the tax guys don't know these things too. Why? Is because all this stuff came out. And this is middle of August. September 15th is a partnership and S Corp deadline. So a lot of people are like, hey, can you get my stuff done? They're flooding me now. Then we have October 15th is individual deadline. A lot of accountants are just like flooded with just preparing back tax returns. 2024, I've got people that still need to file 2020, right? And I'm like, you don't need to file 2020. Let's just do the last 3 years. I'm trying to apply for citizenship. I want to like make sure I get all my ducks in a row. I don't want to have anything that, okay, I've got a lot of people who I'm still preparing. So there's a lot of time in gathering information. A lot of accountants, they don't have time to be proactive because they're being retroactive. Then after the October 15th, trying to catch up and understand this stuff and then go to clients and plan, there's not a lot of time left in the year to do this, as well as some of these advanced planning techniques, like to buy stuff or to buy like a business or to buy an interest in like an oil and gas or a solar type of thing. You have to go and apply and you have to like go through a process, and it can take months. So really starting later in the year, sometimes those companies, like a film, for instance, like there might be a Hollywood film and they're selling like $100 million and they want people to invest 500,000 or 3 million because then you can get a percentage of that. Well, when they fill up, when they sell out at that 100 million, it's too late. And so you got to be early because they might have sold out of their allocated, and then they're on the wait list for next year because they usually first, second quarter, they're selling these credits. The rest of the year, they're managing and actually putting into production the money that you have invested. And then you get, instead of paying your quarterly estimated tax payments, you're going to save. And instead of paying the quarterlies, you just have this investment, and then it's income producing. And then basically you're just kicking the tax time bomb down the road, because with these investments, they'll come due and you'll make income off of it. It'll be passive or active income, but then you'll have this other big chunk of money coming in that'll be taxable. Then we buy and invest. And so it's another cycle of buying, investing, and rolling. And so that's what these strategies. And so understanding what this bonus depreciation, being able to deduct, and what these items are, like for instance, qualified property, tangible less than 20 years, short-term rentals, long-term rentals, leasehold improvements, vehicles, etc. I know that this is really geeky and it's like a lot of nerd stuff, but again, working with the accountants, because I believe the 6 most expensive words are my accountant takes care of it. My accountant takes care of it. And it's not that the accountant is malicious. It's not that they don't mean to. It's just that they don't have time, the bandwidth to really think ahead and to think about these things. That's why I'm trying to educate accountants and clients and be like, let's have checks and balance. Let's work together. Because often I won't know that somebody bought a building or did something until like tax time. I'm like, Buy something, let me know, let me analyze it. If you dispose of something, let's talk about that early. And I'm chasing people whenever somebody says, oh, I bought this building or whatever. Give me the HUD statement, give me the purchase agreement so I can analyze it, so I can take all these numbers and not wait till next year. And so again, it's just being proactive on both sides. I want to get into what the IRS talks about for building components, and this is really important because when we look at a commercial building or residential rental, IRS breaks it up into 8 components. HVAC and plumbing, these are all different components that it breaks up. When we do a cost segregation analysis with an engineer, with a qualified engineer who understands this, we'll break up these different components. And then instead of saying this one unit is, say we buy a building or something, I got an example here. We got this building, 1.3 million, and we invest in improving it. And we don't take off the old like air conditioner and carpet because we might have did a remodel. Most buildings are 39 years, so we have to depreciate over 39 years. But the carpet, the electrical, those things, dishwasher, they don't last that long. Same thing with the residential rental. So if a human lives there, it's going to be 27 and a half years. If it's rented, like this is commercial space, it's going to be 39 years. And that's what the IRS says. We have to depreciate over, and we take a portion of that over that time. Well, most people, okay, will buy the building. We have a building for 1.3 mil. We improve it, but we don't take it off the old books. And what we have is a problem because we have something called phantom tax. And phantom means that we're losing money on not disposing, because if you take the old roof off, the HVAC, the lighting, the carpet, it's in the dump. But there's actually a useful life on the depreciation schedule, on the books. And I see this every day, and it just drives me crazy because the old accountant did allocate out these different components, but they didn't remove it. There was a useful life. It could have been a few $1,000, but it would have been released and you could have been able to expense it. Number 2 is you have to recapture it as if you did have it. If you didn't remove it, this is a double tax, and it's a double whammy, and most people don't know, and that's why this is a phantom. And number 3 is time value of money, because you could have used that money that you saved on that disposing of that asset, could have been $4,000 or $10,000 or whatever, and invest in something else, lower your interest rate, do something to pay off and to invest in the future. And so it's a triple whammy. And that's where it hurts so bad. And that's where having and educating people. And I hear a lot of people talk about cost segregation and having engineering study and going back and looking at these different types of property and how does the IRS look. We took a look at the building, but then there's 5 year, 7 year, 15, 20, 27 and a half, and 39 year. So understanding these things, because then you can be a good, wise investor for yourself, and then also guide clients and just be more educated, be more savvy when it comes to taxes, and help your accountant, help the AI if you're doing yourself or whatever, to make sure things are done right. And then if you get audited, be able to substantiate that audit. So the IRS says 5 year assets, appliances, movable partitions, signs, whatever, 7 year, all these things. So we go back to this building example here. We go down to the kitchen, and there's a dishwasher, $1,000 dishwasher, $300 garbage disposal. That's not it alone, because there's electrical that goes to the plant paneling. And so with the engineering study, we could say, well, there's another $500-$600 for the electrical, the conduit and stuff. And so that $500 or $1,000 could be triple, right? And so then we're allocating that. When we replace that dishwasher or HVAC or whatever unit it is, we get to expense the remaining useful life, because there was a useful life on the books because we threw it out, and we get to capture that and then move forward. So this is so important, and so many people, again, just don't realize the importance of breaking out the components, breaking out a building, not seeing the building as one thing, but instead in these 8 components, And then looking at it from the book standpoint and saying, what can I do? How can I accelerate that depreciation, especially with bonus depreciation? Take that savings now, reinvest it. With home offices, it's interesting because we're not going to do a cost segregation on the house, but I have clients who they built an ADU on their property. They actually move into the ADU and rent out their primary residence. And they do that while they don't have kids, and they have kids and they move back in. So they kind of switch. But if they would have did a cost segregation on their main home and the ADU, they would have had all those components broken down. Then they can accelerate that depreciation, take that tax savings now, and then if they move back in, they just stop it. And then they might buy something else. And they continue to turn that main home and ADU into a rental, but they already did the cost seg. And then when they have to go and replace something, they can remove it, they can allocate out. And so thinking ahead, a lot of times landlords become accidental landlords. Right? How many people have become accidental landlords? And I see this. I got an 83-year-old client right now, and he just bought another house that's just right next to him. Is this too good to be true? He's like, he had to buy it, and then started looking at, well, if he would have invested that 500 grand into the market, well, he would have got some appreciation and stuff like that. But because that 500 went into real property, it's triple benefit. He gets a tax deduction now, somebody else is paying for the mortgage, and then he has appreciation. With stepped up basis, a lot of times people have a strategy of buy, refinance, die. Buy, refinance, die. A lot of times people, they don't sell. They let it go. They take their investment, if it's stocks, bonds, or whatever, or if it's property or businesses, to death. Because then a stepped up basis, the person that's inheriting it would now get the value at the time of death and not the purchase. So now the gain is on the time of death, the value, and not the purchase, because somebody might have bought a farmland 20 years ago and now it's all developed and bought it for 40,000. Now it's worth 3 million or whatever, right? So time of death, and they can continue to refinance on it. And there's different situations. When does it make sense that somebody would sell it to their kids if they have high medical? There's all these different what ifs, but this is just like a starting thing of like understanding cost segregation is so important. And it costs $2,000 or $3,000 or $5,000 to do it with an engineering study, because they have somebody that's reputable and that's going to stand behind an audit. Because in a lot of audits, the first thing on the information document request, the IDR, is who was the engineer that did this cost seg. And if it's some computer program, well, is it reputable? And so I've seen a lot of cost segs just get thrown out, and they have to recapture, and they have to fight, and they have to go back and do it, and it's just expensive. And so do it right the first time, save. And so a lot of times, and I've seen some people will do it on an $80,000 condo, and it costs $5-6 grand to do a cost seg, and they're like, it doesn't pencil out to do the cost seg by itself, but I don't want to be overpaying my taxes. I want to break it down to the studs. I want to understand, because when I remodel, when I flip it, when I do a 1031, and so sometimes people do a 1031 exchange. It's for like kind property. They trade so they don't pay the tax. Now they trade it in. But there's also lazy 1031s. Who's heard of a lazy 1031? Anybody? So lazy 1031 is, I sell my property, I'll go, I buy another property, then I do a cost segregation on it, and I componentize, and I take advanced depreciation, and then it offsets that gain. So I don't have to do a 1031 because I have all this loss. So it's just another way. Talking about construction and manufacturing. For 4 years, the government is giving, instead of taking like all this building and it's going to be 39 years, it's going to be 100% depreciation. If you buy this property at say 10 million, instead of normal depreciation be $256,000 over 39 years, if you could expense it now and you're at like the 37% tax bracket, it's 3.7 million. If you go invest in this property, costs 10 mil, it gets constructed, you save 3.7 million on taxes. Instead of paying taxes now, you're using that to leverage other stuff. This is very powerful. This is bringing manufacturing back into the United States because we're so dependent upon other countries for most everything, and especially chip manufacturing. There's a huge incentive to have microchips built back in the United States because it becomes a national security issue, actually, because we got to have enough chips. Manufacturing, and that's where, as maybe residential rental or residential real estate agents, how does this benefit you? Well, you might be knowing, hey, there's a manufacturing, there's people that need to start working. We're the next housing. And then we start coupling these incentives with what we'll get to opportunity zones, research development credits. And so start coupling these things, even being an investor, working with people, but being ahead of the market, seeing where the trends are, where are people moving is going to be really important. So this is huge. And the people that know this are already retooling and they're taking advantage of this stuff because with the energy credits, and I've got clients who were in the energy sector and they were doing solar, and now they're pivoting. They're pivoting to microchips because they're taking that same technology of those clean rooms and manufacturing and production, Six Sigma and Black Belt and all that stuff, and starting to retool and have rebuilding new buildings, building new facilities, taking advantage of these credits, but then taking advantage of like R&D credits, the opportunity zones, the 2.0. Who's heard of opportunity zones? You guys know where Sherman County is? It's like east of the Dalles a little ways. It's like Wasco County is the Dalles, and then Sherman County. I grew up in Sherman County. Rolling Wheat Fields itself is an opportunity zone. And so there's a lot of like wind farms and stuff. There's opportunity zone 1.0 and then there's 2.0, and there's this gap between the two. So one's phasing out and the other one's phasing in. Next summer, July 2026, the IRS will give the governors the ability to identify the new opportunity zones. Oregon is losing 22% of its opportunity zones. It's going to be a lot more important to think about that and help investors and to even invest ourselves into those for businesses, because it is tricky and there's some debate about, can we do a 1031 into a qualified opportunity zone? Sometimes. I was on a conversation with attorneys yesterday and they're like, yes, we can, but this is how we do it, and it becomes tricky. But understanding with opportunity zones, there's something called the stepped up basis. So if you buy into it, you sell a highly appreciated asset like crypto, building, whatever it is, stock, business, you can buy into the opportunity zone and you don't have to pay that tax up to a certain amount of time. And I think it's for the 1.0 is like next year, December 2026, like the dates. But then if you hold it for a certain amount of time, they forgive. You have a stepped up basis of like 10%. And so it's great because you don't have to pay the tax till later. And then they forgive, that's free money. And so take advantage of that. And then the 2.0, it made it longer because the 1.0 was expiring. A lot of people didn't really think about it. But if we were to invest in the 2.0 and to build a building, residential, commercial, whatever, then anything, we have the basis. So we have stepped up basis if you invest in it. So their stepped up basis is one thing. Number two, the gain that when you sell it, if you hold it 10 years, you don't have to pay any gain on it. So if you take a cost segregation and strip all the equity out and save on taxes now, and you go sell it in the 10 years, you're not paying tax. It's a beautiful incentive to really reduce your tax rates, because if we can reduce our tax rates and not have that expense, that increases our cash flow, and that means we can be more competitive. We can have lower prices, we can have more research development, we can hire more people. So there's a lot of benefits to it. It is complicated. all this stuff is complicated. It's not easy, but it takes discipline, it takes research. But for those who savvy investors who want to understand this, who want to be on top of this and using strategy, understanding tax policy drives investment policy. Tax policy drives investment policy. So if we can understand the tax be the driver on these investments and retool quickly, it's about survival of the fittest. It's about retooling. It's about Blockbuster not selling DVDs anymore and renting, but going to the cloud like Amazon, Prime, Netflix, and whatnot, right? So we don't want to be that Blockbuster. We want to be more Netflix and Prime. Okay, so research, development, credit. This isn't something that maybe most realtors are going to see directly, but they might have partnerships. They might invest with other people. They might partner and have a lot of investors who have real estate license because they're buying real estate and they want to know and they want to get a deal and they want to save money on commissions. They want to have the insight. So I have a lot of savvy business owners who are both realtors. They have other businesses and they're doing research development. They might real estate investing in one of the 10 different incomes that they have coming in. It's hard to manage, but this understanding that research development is a very, very important thing. Again, for national security, for chip manufacturing, for energy, all this stuff. AI is such a huge industry. It's a multi-trillion-dollar industry. And these big servers and the big computers to run these AIs takes so much energy, takes so much electricity, and then you got to cool it down. You got all this hardware and software, and it's a lot. And especially these like mining, crypto mining things could be like a big, huge stack of computers, and it's just eating up so much energy, and it's so hot, and you got to cool the things down. Pass-through entity tax, PTE. This is really important. A lot of people don't understand this. Something to really think about. This is getting back to the personal tax return. So on the personal tax return, you itemize. You can either take standard deduction or itemized deduction. And this is for personal. This is not business. So on the itemized deductions, you have medical, you have charitable, you have mortgage interest, you have property tax, and the state of income tax. And that's that property, state, and local income tax is SALT. Individual, state, and local income tax. That's what that SALT means. So since TCJA in 2017, the Jobs Act tax cut came out, it lowered it to 10,000 as capped. And so 2024. Now in 2025, it goes up to 40,000 with phase outs, right? Unless you're over 500,000 or 250. And then it's going to go back down 2020, 30. It's supposed to sunset back down. What this does is allows you to take state and local income tax, not local income, but state income tax that you paid through an entity, like an S corporation or a partnership. And so it's a tax savings. And if you can pay it through your entity and you have to set it up and you have to make those payments through your entity, and then you can free up and you can have other things that eat away at that 40,000, or when it starts to phase down, or if you're over 500,000. So it's another way to save on taxes, another backdoor. Startup stock, 1202. This got enhanced because of the new big beautiful bill, and this is for people who have C corporations. And when you sell your stock in the C corporation, you have to hold it for a certain amount of time. You don't have to pay tax up to $10 million. It's a big exclusion, and it's a big tax savings because a lot of times people don't want to sell their businesses because they're going to get a 40 to 60% haircut on taxes. And they're like, I can't afford that. I need that money. And so they'll continue to run that business way longer than they should because they can't afford the taxes on the sale. A strategy to do that for businesses that qualify for C corporation. a typical realtor probably isn't going to take advantage of this, but you, again, might have strategies of investing with other people. So I wanted to present that and to say on a high level overview, this could be something to think about. The next thing is this 1031 exchange, which you guys would probably, you're maybe a little bit more familiar with. It's interesting because 40 to 60% of 1031 exchanges fail. Do you guys know why?
They don't identify a property.
Right. So yeah, you got to identify 3 properties within 45 days, and then you've got to execute on one of those within 180 days. A lot of times people will go and sell their property, and then they'll start trying to identify the new ones. They can't. So it's better to try to identify the properties before you sell it and get those 3. There's a lot more audits, especially with the AI audits. They can just be like, hey, upload the documents, and have AI go through a lot faster than humans. Did they identify? Was there a third-party facilitator? Because we have to have a third party, it's called a qualified intermediator, handle all the funds, because if we have constructive receipt, then that 1031 fails. And constructive receipt means that we control, we have that money, we can actually touch it. So we can't touch it. We got to use this qualified intermediator. You guys probably have people coming in that talk about 1031s. The company that I work with, they don't charge any fees for 1031. And so a lot of times companies will charge $800 to $2,500 up front, but then they really make their money on the back end on holding that money in this escrow, and they're making money off it. The company I work with, if you have more than $1 million in a 1031, they'll give you 1%. So if you had like 5 million and you held it for 180 days, that's like 200 grand. So there's a lot of money in this short-term interest. 453 deferred sales trust, Internal Revenue Code 452. Most people have never heard of this. Most accountants never heard of this. So it's an alternative to doing a 1031. Instead of doing 1031, you set up a trust, and you can do this with charitable remainder trust or deferred sales trust, and you transfer that property into the trust. The trust sells it. You don't have constructive receipt. You don't hold the money. You don't control the money. And then you get a payout over a certain amount of time. So instead of paying the tax now and getting hit with this big tax tsunami, that you get to have more control and pay it out. You do have, working with this custodian, you can invest in another property. You can actually do a 1031 within a deferred sales trust. So you might, some people get tired of tenants, toilets, trash, and taxes, right? They get tired of the 4 T's. They get tired of the tenants, and so they could do a 1031 into a part of the property, or if there's boot, or there's all these other rules. And so instead of doing a 1031 because they're tired, they want to retire, they want to get out of this, they put this into this deferred sales trust. They don't get hit with this tax tsunami. It doesn't mess up their IRMA, Medicare, Social Security torpedo, those types of things. So it's another strategy to just evaluate. And so most people have never heard about this. That's why I'm bringing these strategies, saying, hey, there's some options here. And high level overview, take note. Let's talk about it. If you have a highly appreciated stock or crypto, or, I mean, there's people that are selling $10 million of crypto. I don't want to pay the tax now. I want to pay it over time. This could be an option.
Yeah.
So similar to charitable remainder trust, most people don't know this. You can exit and get lifetime income in a term that's kind of like a annuity, where you put it in there, you donate it, and so the charity will get it over time, but you get to use that money. You have to set it up. It's a third party, but then you can actually use that money and get that money. Deferring, you have steady income. There's options instead of doing a 1031, instead of selling. Most people are like, I'm going to get with a big tax bill. What are my options? And most accountants are like, I don't know. Right? You just got to pay your tax. Well, I do know. And that's where I come into place, and they're like, hey, you have options. What do you want to do with the money? So my first question is, what do you want to do with the money, and why, and when, and how much money do you need? Some people want to go buy a baseball team, or some people want to retire, some people want to donate, whatever it is. how much money do you need? When do you need it? Why do you need it? Type of thing. So, and there's these options. And most accountants have no clue on this stuff because they're so focused on doing. And again, I'm not trying to throw accountants under the bus, but I've been a part of the problem for 24 years, and I'm like, I'm sick of it, and that's why I left the IRS, because there's more options. And I saw people who were overpaying their taxes and sitting there with their accountant, CPA, attorneys, whatever, and it's like, if they would have did this, they could have saved X amount of dollars. Nobody's ever saying anything because they're just worried about filling out form. So here's like kind of an overview of 1031, charitable remainder, 1221 or 1202 stock, the opportunity zones. And so it's this kind of a high level overview. This is like the tip income. A lot of times people were hearing this in the news. What about servers and tips and all this other stuff? I went out to eat over the weekend in Hood River, and there's a larger group, and it was required mandatory tip. It was 20%. With this new thing to exclude, it's got to be voluntary. That system failed because it was required. They, because of their system, it's a month old. But because it was required and not voluntary, then they don't get to exclude. There's phase outs of 150, 300,000. It's only up to 25,000. It's on the, you have to put it in a W-2. The W-2s won't be updated until 2026. It's just a mess. It's just a mess. Does this apply to realtors? No, unfortunately it doesn't. I got nail salon people or eyelash people, and if they were a W-2, then yeah, and it goes through all that, yes, that would work. But since they're self-employed, and even though we're doing a W-2 on an S corp, we're running the numbers and it just doesn't make sense because of the reasonable comp, and it'd actually be paying more, breaking even for all this extra headache. It's just not worth it. Yeah, because there's other tax strategies that we can do, meals and home office and Augusta rule and stuff that, yeah, I can come back and talk about later. Overtime deduction, if you're a W-2 employee and you're working for an hourly rate, you can exclude up to 12,500 or 2,500. So you might see this stuff in the news. Here's some examples. Does this apply to you guys? No. Does it apply if you have an S corp and you're paying yourself? No. Why? Because you're not an employee that's subject to overtime rules because you're an owner of the business. It's pretty limited. There's going to be a lot of regulations that are coming out. Meals deductions, you might have heard about this. This is for employers with employees, like with Google, these big cafeteria type programs. That is now, it was 100%, it went down to 50, and it's going to go to 0. But like this office, everybody's 1099. Well, you're not employees, and so you have meals or donuts or coffee or whatever. That's for customers and not for employees. There's still 100%. It was confusing because in the news, there's no more 100%. No, there is for employee picnics and parties and public goodwill and meals and stuff like that. You have an open house, you have the ice cream, you have the donuts or whatever. That's still 100% because that's marketing and advertising. Because when I was reading and seeing stuff in the news, it made it sound like realtors would not be able to deduct anything or deduct it at 50%. No, you can't, because it's not for an employee, it's for marketing, it's for advertising. Deduct it that way. You give the gift basket instead of giving it to Jane and Joe client, it's to, if they had a business, it'd be better for the business. There's always these business things that you're called a marketing. Senior deduction, so you hear about people over 65, there's a $6,000, it's above the line. Just wanted to throw this in there and just say that this is available. Gambling losses, this is kind of a bummer. It's limited to 90% of winnings. For example, somebody wins 10 grand, they lose 12. Well, the new rule is that you get to deduct the 90% against the winnings of 10 grand. You just got a haircut of 3,000 basically, because you lost the 2,000 plus you I have to lose that extra $1,000. Interest on car loans for new cars. This is not business vehicles. This is anybody. If you have a vehicle that is assembled in the United States, that's under certain 14,000 pounds between 2025 and 2028, you get $10,000 interest on passenger vehicles, but there's 100,000 single or 200,000 phase out. It's meant to spur on the economy to have more deductions. If they get audited and they're like, prove it, then what? Then they lose it. Another thing is that's where we figure out the tax and maybe want to do a 4 or 5 3 deferred sales trust and pay that tax later over time instead of like this big tsunami. It's like more even over time, so you avoid that IRMA, because IRMA cliff is when you're getting Medicare when you're 65 or whatever, whenever you start getting it, and you get over a certain amount, then you'll pay more. And most people in retirement are like, I don't want to pay more for health insurance. I want to keep it down. And so if they have this big sale on a property or a business, that's going to hurt. And they don't want to pay more. So let's spread that out over time. Or even like, for instance, Roth or traditional to Roth conversions. As we talked about the lazy 1031, well, somebody could also do that on a conversion. They buy a property, they do a cost segregation, they're releasing this tax, and then they're rolling over traditional, and they're not paying a high tax bracket, they're decreasing their tax. So don't lose an advantage of a lower tax year. Roll things over, put things in a Roth vehicle. The Roth vehicle, self-directing is so important and big. Be able to direct your own retirement account and buy property, buy cows, buy crypto, buy whatever. You just can't buy wine because wine becomes, instead of a wine collection, a bottle collection, right? Wine just seems to disappear somehow. So there's certain things in certain insurances, retirement accounts, you can buy a life insurance and some you can't. So there's a lot of nuances with that, but self-directing is really cool and popular. Well, thank you for coming to this tax class, and hopefully it was educational. I'm here as a reference and a resource. I'd like to thank Berkshire Hathaway for hosting this event. I'd like to thank Mel from Old Republic for sponsoring this and making it happen. Please click on the QR code to get access to these slides and stay in contact.